Welcome back to the Deep Dive, where we take a heavy stack of quarterly reports, investor presentations, and analyst notes, and really just distill them into what you need to know.
Exactly. We cut through the noise.
Today, we're focusing on a really compelling story in the Indian consumer space, Mrs Bectors Food Specialities. And this isn't just about, biscuits and bread.
No, not at all. It's much deeper. It's a company that sits right at the intersection of some massive consumption trends we're seeing.
And what's the backdrop looking like right now?
Well, our sources are pointing to a pretty favorable environment. You have inflation on key inputs starting to stabilize, which is huge. And more importantly, you have India's growing middle class, which is driving this structural shift towards more premium, healthier food options.
Okay, so that macro context is key.
It's essential. It informs every single strategic decision Mrs. Bectors is making, especially when we start talking about their heavy investment cycle.
So our mission today is pretty straightforward. We're going to unpack the company's financial engine, we'll look at the P&L, we'll scrutinize the balance sheet, and we'll track the cash to give you a really clear picture of the opportunities and, just as important, the immediate risks.
It's a complete fundamental checkup on a company that's really in an accelerated growth phase.
Before we jump into the numbers, if you find real value in these detailed breakdowns, if this knowledge is helping you connect the dots, please take a moment right now to like, share, and subscribe.
It really does help us keep these deep dives going.
And don't forget to click that bell icon. That way you'll get a notification the second our new analyses are released. Okay, let's unpack this business. We all know the name Mrs. Bectors, but what's the core identity here? Are we talking biscuits, bread, or is there a more complex structure under the hood?
It's a classic dual-engine model, and understanding the separation is, I think, the key to understanding their entire cash flow and margin profile.
Two engines. Go on.
So engine one is Cremica. That's their legacy brand, biscuits, cookies, crackers. It covers the domestic retail market and a big chunk of their exports.
There you get Cremica. And the second?
The second engine is English Oven. This covers your retail bakery items, sliced bread, buns, and, this is critical, their B2B institutional supply segment.
Ah, the B2B segment. That sounds like it could be the secret sauce. Who are they actually supplying there?
It creates a massive, genuine competitive advantage, what we call a moat. Mrs. Bectors is a preferred supplier to the top quick service restaurant, or QSR, chains in India.
You mean the big global names?
The biggest. We're talking about McDonald's, Domino's, KFC, Subway. The sources highlight that they're one of only 2 key vendors in India that can provide these processed, dough-based products to these huge institutions.
Why is that such a powerful moat? Just supplying to a few big chains?
Because the barriers to entry are incredibly high. These relationships demand, absolute precision, massive scale, and really strict quality control that just cannot fail.
So once you're in, you're in.
Exactly. Once you've secured those contracts and proven your reliability for years, it's extremely difficult for a new competitor to just come in and dislodge you. This B2B segment really anchors the whole company.
And that's where the strategy connects. That strong B2B moat gives them the cash flow to take some risks on the consumer side. How are they leveraging that?
They're executing a very clear strategy of innovation and premiumization. They're not just trying to compete on price. They're explicitly targeting that upwardly mobile consumer.
What are some examples?
Just look at their new launches. Nature Bake, their clean label brand, is a big push. It promises zero maida, no palm oil, no preservatives. Then you have shortbreads with 25% real butter and zero maida coconut cookies.
That shift toward premium and clean label sounds expensive. Higher input costs must hit the profitability metrics pretty quickly.
It does. And that brings us perfectly to the financials. Let's start with the income statement, the P&L. What's the top line revenue story?
How has growth been?
The top line's been very robust. Over the last 3 financial years, the company has delivered a solid 24% compounded annual growth rate, or AGR, in sales.
And just a quick reminder, CGR is?
It's the average rate of return over that period. So revenues have climbed consistently, going from about 1,362 crore up to 1,874 crore over the 3 years ending FY25. It shows strong market penetration.
But growth is only half the picture, right? How efficient is that growth? Let's talk about operational profitability, which means talking about EBITDA.
Absolutely. And for anyone listening, EBITDA stands for earnings before interest, tax, depreciation, and amortization.
It's basically the true operational profit.
That's the perfect way to put it. It shows you how much cash they made just from baking and selling food before you factor in financing and all that.
So how have those EBITDA margins trended? Because with all this expansion and premium ingredients, I'd expect some volatility.
And you'd be right, the margins have been volatile. They were at 12.9% in FY23, then they peaked at a very healthy 14.9% in FY24 before moderating down to 13.4% in FY25.
That peak in FY24, what was that about?
That was likely driven by some temporary raw material tailwinds that have now disappeared. The moderation we saw in FY25 and into the recent quarters is the direct result of input price hikes and the initial costs of ramping up new facilities.
That volatility is a critical point. What about the bottom line, the actual profit for shareholders? How has PAT, or profit after tax, moved?
PT, which is the ultimate profit, really just mirrors the EBITDA trend. The PAT margin went from 6.6% in FY23, peaked at 8.6% in FY24, and then settled back down to 7.6% in FY25.
So the challenge for management is getting back to that peak.
Exactly. Can they get back to that 14% plus EBITDA band consistently? That's the big test.
Let's zoom in on the most recent performance, Q1 and Q2 of FY26. They hit their highest ever quarterly revenue in Q2. Where did that acceleration come from?
The story really shifted between the two quarters. In Q1, total revenue growth was a bit muted, 7.6% year over year, and the growth was almost entirely from the bakery segment, which surged 19%.
While the biscuit segment was lagging.
Dragging, really. It was at just 3% year-over-year growth, a huge discrepancy.
So did the biscuits recover?
They absolutely did in Q2. Total revenue growth accelerated to 11.1% MIOY. The biscuit segment jumped to 10% growth, while bakery stayed strong at 16%.
What turned it around?
Management said it was domestic biscuit growth improving after they navigated some temporary headwinds around GST implementation. It suggests the underlying demand is still pretty robust.
Okay, moving on from profitability. Let's talk financial health.
Yeah.
The balance sheet and cash flow. Is this aggressive growth being funded by strength, or are they just piling on debt?
The balance sheet is a key positive right now. I mean, a big one. The company has been laser focused on debt reduction.
How much did they cut?
Total borrowings fell from about 225 crore in FY24 down to a much healthier 131 crore in FY25. And at the same time, their equity, their reserves grew strongly.
So they're funding it themselves.
Largely, yes. Strong internal accruals are funding growth, and they have a healthy dividend payout ratio of nearly 20% over the last 5 years.
So less reliance on banks. But is that reported profit on the P&L actually turning into real cash? Let's talk operating cash flow, or CFO.
CFO is so crucial. It measures the cash you generate from your day-to-day business. It really tells you about the quality of the earnings.
And for Mrs. Bectors?
In their case, CFO has been exceptionally strong and steady. It's stayed in a tight range, between a 153 and 164 crore across the last 3 financial years. That's excellent cash conversion.
But if CFO is that stable and strong, what explains the massive cash outflows we see under investing activities?
That's the core of their strategy right now. Massive capital expenditure, or CapEx. Cash used for investing just surged from 151 crore in FY23 to over 331 crore in FY25.
Wow. So where is all that money going?
New capacity. They've invested over 716 crores between FY21 and FY25, and they're planning another 400 crore this financial year. They are building the infrastructure for the next decade of growth.
Okay, but if they're investing hundreds of crores into new factories, is that stable CFO figure around 160 crore a year? Is that actually enough to fund that kind of expansion without taking on more debt?
That is the right question to ask. And for now, the short answer is yes, they can manage it because of those high internal accruals we just mentioned. But the sheer volume of this investment puts immediate pressure on their efficiency.
Which brings us to our next point.
Exactly.
So all this capital is pouring into new plants. What does that mean for the shareholder right now? How effectively are they using all this money? Let's get into ROE and ROC.
These are the efficiency metrics. First, you have ROE, or return on equity. It tells you how much profit is being generated for every rupee of shareholder capital. That was 15.6% in FY25.
And the broader measure.
That would be ROCE, or return on capital employed. It measures the profit generated per rupee of all capital used, both the owner's money and any borrowed money. That stood at 18.1% in FY25.
Now, I saw in the sources that ROCE has actually dropped quite a bit from a recent high. Should we be worried about that?
We need to analyze that drop critically, yes. It fell from a high of 25% in FY24 down to that 18.1% in FY25.
That's a significant fall.
It is, but it needs context. It's a textbook outcome during an aggressive expansion phase. The reason is something called CWIP Capital Work in Progress.
CWIP. Okay, for those less familiar with the balance sheet, what exactly is that and why does it hurt efficiency?
CWIP is basically assets that are being built but aren't operational yet. Think of an uncompleted factory or machinery that hasn't started producing anything.
Got it.
So this capital is employed, it's in the denominator of the ROCE calculation, but it's generating zero revenue and zero profit. So until those new plants come online, the C/I acts as a temporary drag on the efficiency ratios.
So the drop in ROCE isn't a business failure, it's more of a strategic trade-off.
Precisely. They are sacrificing current efficiency for what they anticipate will be massive future scale. The thing to watch is whether those ratios stabilize as the plants start producing in FY27.
Okay, let's pivot to that future. What are the key strategies management is pushing, and what are the biggest risks they're facing?
The primary growth strategy is capacity expansion. They want a true pan-India presence. Their new biscuit facility in Dar just started operations and is ramping up.
And on the bakery side?
That's all about geographical expansion. The Kolkata plant is set for commissioning in Q3, which gets them into East India. And the big Khopoli plant in Maharashtra, targeting the West, should be ready towards the end of FY26.
So the goal is to become a top national player in bakery.
One of the top 2 or 3, that's the stated goal.
And what about internally? What are they doing to help those volatile margins we talked about?
Internally, they're pushing something called Project Impact 1.0. It's a company-wide program focused on cost transformation, strategic sourcing, optimizing logistics, basically wringing out inefficiencies.
And are they using technology for that?
Yes, a big part of it is digital. They're rolling out a distribution management system, or DMS, to a majority of their distributors. This gives them real-time visibility into inventory and sales, which is just critical for a business this size.
Okay, finally, what are the clear red flags, the major headwinds we need to keep an eye on?
There are 3 main risks cited. First is export uncertainty. Now, exports are a small part of sales, maybe 5–6%, but they're high margin, and they're being impacted by geopolitical tensions and fluctuating U.S. tariffs.
Which can be unpredictable.
Very. Second, the stabilization costs of all these new plants. They'll incur fixed costs in the short term, which will suppress those EBITDA margins until they hit full scale, likely in FY27.
And the third risk?
Just plain old competitive intensity. The domestic biscuit market is fierce. It requires constant, heavy investment in advertising and R&D to stay relevant. So, to synthesize everything we found in this analysis, we can really summarize the 3 biggest positives and the 3 most significant risk factors for any discerning investor.
Let's start with the upside. What are the top 3 positives that really stand out?
Number 1 has to be the robust balance sheet and cash flow quality. That debt reduction down to 131 crore with strong, consistent operating cash flow, that's a very sturdy foundation.
Okay, what's number 2?
2 is the bakery segment momentum and that institutional QSR moat. The bakery business is the clear growth engine right now, and that underlying QSR relationship provides invaluable volume and margin protection.
And the third positive?
The aggressive capacity and premiumization drive, the huge CapEx commitment, that 400 crore plan for this year, paired with the focus on premium products like Nature Bake, it just signals a very ambitious plan to capture market share.
All right, now for the risks. What are the top 3 negatives or challenges that you think investors must keep a sharp eye on?
First, margin volatility. EBITDA margins have compressed down to the low 12% range. Management has to prove they can execute their plan and get back to that 14% plus band consistently.
That's the big one. What's next?
Second, the short-term efficiency drag. All that capital tied up in CWIP means ratios like ROCE are depressed. Investors are basically waiting until FY27 for that capital to really start generating returns.
And the final risk.
And third, those export headwinds. Geopolitical volatility and U.S. tariff uncertainty. It exposes a small but valuable part of their revenue to risks that are completely outside of management's control.
That brings us to our final provocative thought for you. The central measure of success for Mrs. Bectors over the next few quarters isn't just about achieving top-line growth. They seem capable of that. It's really about margin expansion.
That's the key.
Can the efficiencies from Project Impact and the stabilization of this massive new capacity overcome the short-term pressures? And crucially, can they deliver that targeted 14% plus EBITDA consistently? That successful execution is the story we have to watch.
That's the measure of success.
That concludes our deep dive into Mrs. Bectors Food Specialties. We really hope this breakdown has added significant value and clarity to your understanding of the company's fundamentals.
And its strategic roadmap.
If it did, please show your support by liking, sharing, and subscribing. And also, please hit that bell icon so you never miss our in-depth analysis. Thank you for listening.